because I'm asking seriously, if we break below 4.2% in the 10-year and stay there, what do you think the reasons are, first and foremost, for breaking below 4.2%? And then what would be the reasons for staying below 4.2%?
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Yeah, for me, that would be driven by the idea that this growth slowdown is getting worse, and that we're going to go from some sort of disinflationary growth trajectory to maybe some deflationary growth trajectory, or a disinflation growth to a real slowdown. And the retail sales numbers that we got for the last 2 months, which are bad, are just getting, this is just the beginning of it. It's getting worse. The housing market is locked up. Claims continue to move higher. Travel starts to slow, and it's the growth slowdown is here finally, and the Fed is late, and the narrative shifts to the Fed's behind the curve. The Fed should be cutting. They're not cutting. Why aren't they cutting? They're missing it, and then that's the bond market rallying because the Fed is late. And so that means the slowdown is going to be worse than expected, which is why the bond market is rallying even further. That to me would be the narrative. So we'll see. I mean, Atlanta Fed GDP for the second quarter is still up over 3%. So it hasn't happened yet. But I mean, look, I think retail sales today were not particularly good, but the IP and capacity utilization numbers were fine. So, we get claims, we get housing numbers later this week, a flash PMI on Friday. And then next week, we get some regional stuff, and then the PCE on the last day of the month, which well articulated. People kind of already know what that's going to look like. Now it's going to come in pretty light because we just saw components already come in. So it looks like a 0.1 month on month and 2.6 year on year, but it's kind of a known number at this point. So I don't think that necessarily does anything. And then we walk in July, have that payroll print, the PMIs, and we'll see. Look, if the payroll print is good again, and that wage number is good again, people will have to say, you know what, this slowdown is not happening like I thought, or not as quickly as I thought. Bonds will sell off then at that point. So that would be why the 10-year doesn't stay under 4.2. But I think that's your narrative. And the other narrative that will add to that would be more momentum on this French election that pushes in the direction of Le Pen winning more seats. I think that would be bond bullish as well for treasuries.
Okay, so that's that yield differential spread blowout is basically flowing out of Europe and into US bonds. Yeah. Okay, so what about what I was going to ask you? There's the steepener we always talk about. I want to get that chart up again. We continue to invert in the 10 and 2 year yield curve. Any comments on that? We're still inverting. This hasn't dumped into my gap fill of 0.58, but we're still inverting. Now try and square that circle with what's going on.
I'm struggling with it because I think it's because I struggle with I don't really buy into the narrative about this long end being so bid. It's like term premiums are basically flat or negative, and the Fed's going to be still slow to cut. Why would you want to buy a 10-year at 4 and change when you could still put money in 3-month T-bills? So there's very little risk of a imminent Fed cutting cycle that is so large that you will have refinancing risk. You should just keep your money in the short-term paper, 3-month, 1 month, 3-month T-bills. And then if you have to roll it in 3 months, at that point, if you feel like the Fed's going to start cutting, okay, then you can start putting it into, but putting it into duration here at such an inverted curve with term premiums negative, it doesn't make sense to me. So
unless you are more unless the bond market's telling us maybe we are getting that economic slowdown, maybe we are going to get more of a hard landing.
And it's possible but I don't hear that from anybody. So I see that from the pricing action.
That's all I'm asking. Me, I look backwards.
But I don't hear that. I see that in the price. I see a yield curve flat inversion.
Yep.
And that would be, to me, indicative of what I was saying earlier, which is I think the odds of a hard landing are actually growing. But I don't hear that from people
I
from people.
know.
So it's not, and that's fine. But if I started to hear more about folks getting concerned about the pace of growth abroad and then into the US, and that the odds of a hard landing maybe are rising, or the Fed, that this narrative is shifting on the Fed, they're going to be late, then that makes sense. The curve will continue to flatten for a bit more. And equities at that point really should start to come in more in a larger way, right? We should stop this. It's just relative underperformance. It should be absolute equity selling. So maybe we'll start to get there in the next few weeks.
So you had a tweet once. It was like, I took one quote out of it on the 13th. I really liked it. So the Fed is shifting in a hawkish direction as the data is shifting the wrong way. I think the bond market basically said, oh, well, guess what? We don't think you're going to, move aggressively in this rate cutting. But we actually do see banks as a risk here. This bear flattener because of deeper inversion. We have disinflation for the most part right now as far as an impulse, but maybe that picks up because liquidity is inflationary. Lack of that liquidity is disinflationary. And you've just mentioned over and over this RRP, this TGA, this Fed balance sheet is it waning or waxing when it's going lower? It doesn't matter. The point, it's a rolling over. That takes liquidity out of the system. And by nature, I'm swagging this, but by nature, pulling liquidity out of these huge funding programs and or balance sheets are by nature kind of deflationary. So maybe that's another thing that the bond market is sniffing.
Yeah, look, I think, it's no secret I've been negative on small caps, and as the data has gotten, look, the correlation shifted, right? I mean, there was a time up until really the middle of May when lower yield were bullish for small caps, because people were thinking, okay, that's going to help their funding, and so there had been that rotation back into a rally broadening, where small caps were outperforming as bonds were rallying, as yields were moving higher. And what I said was, there will be a time when that correlation breaks, because bonds will be rallying because growth will be slowing, and that will not be the time to buy small caps. You will not want to own the most levered companies operationally and financially when the economy is starting to roll over. And I think that we are in that now, right, for the last 3-4 weeks. And I said after that CPI print, I said, this is a terrible print for small caps. And if you remember, gapped up in the morning, small caps I think were up like 3% on CPI day, and they've really done nothing but sell that again. From that point, they were up today, and so I think that will continue. Look, if the data keeps rolling over as I would expect, then the rally is not going to broaden. The rally is going to keep getting narrower and narrower. And from a liquidity point of view, look, these are the time of the month and the time of the year really kind of matters. We're shifting around, tens and 50s and hundreds of billions of dollars like nothing. But we literally just, we just put $175 billion into the TGA over a 2-day period. Now some of that came out of the RRP, and people thought that was bullish because the RRP was getting drained, but then it was back up today. So we're shifting around. But Yellen has said that, she expects the TGA to end at 750 for this quarter. So that means that the TGA will run down a little bit between now and the end of the quarter, but it's going to go up to 850 at the end of the third quarter. So that's $100 billion liquidity drain. That's coming from Yellen all by herself. And then if yields on the RRP stay high, then you're going to keep getting money flowing into there. That's going to come out of bank reserves. So there's been folks who've been talking about this liquidity reacceleration. I don't see it. I know people have responded to some of my Twitter stuff and saying, "Oh, I see liquidity." I don't see it. We still have QT going on. Yes, it's at a reduced pace, but the balance sheet is still being reduced, and it'll be reduced every month from now until for the next 12 months. So liquidity is still coming out of the system. And look, but it's not just liquidity; it's some combination of liquidity and volatility. And volatility, we need to start seeing something that shakes the tree on volatility. And it's not going to come from, look, maybe it comes from there was a headline out about margin requirements for 0-day expiry trading.
They can always,
we'll see. I mean, they should do it. I mean, it's ridiculous that they haven't done it already. I don't get the sense that is something that is imminent, but but the exchanges and the OCC and the clearinghouses, they can implement those types of changes rather quickly. Like they don't need a Congress to right. This is like the exchange could just say margins are going up, right? So that's the type of thing that could happen. That would lead to a volatility enhancement. That would lead to a deleveraging and system-wide risk reduction. So that's the type of thing that could come out that could lead to volatility up. Talk about these elections can raise volatility. You're not gonna, but I don't think you're going to get a lot of volatility from like the Fed right now, and you don't get anything from Yellen on the next QRA until the end of July, and she has said that she doesn't expect to raise the levels of duration issuance the rest of this year. So even with the $400 billion of miss on the deficit, somehow she's not going to be raising the duration supply numbers. It's pretty irresponsible of her, but it's within her right. And so she'll just fund it more out of T-bills, I guess, but still a lot of paper that needs to be sold. So, that's your liquidity kind of continuing to come out over the course of the third quarter while the Fed is sitting on its hands, not dealing with a slowing economy. Maybe you have this European election stuff going on. China seems like it's just kind of meandering along, right? Not really doing a whole lot of stimulating, not really doing a whole lot of deflating, just kind of almost seems like it's waiting it out to see whatever happens with the next administration here. Obviously, the rumblings on Taiwan kind of get loud and get soft every once. I don't suspect that anything's going to happen, but you never really know. So that's a potential exogenous risk. And then, the other geopolitical Middle East exogenous risk kind of sits out there. And then the BOJ, I think we've kind of hammered that a bunch of times over the course of the last few calls, but they seem to want to tighten and are afraid to tighten at the same time. So I guess they don't really know, but the other, I'm just trying to think what else. Oh, and then the last thing is just the U.S. political situation.
Oh yeah,
look, we have a debate next week. Trump and Biden are debating next week. Now, normally I would say that's a pretty much a zero. Don't need to watch. Market doesn't care type event. Yeah. Maybe. The only reason I would say that there's a small reason to care would be obviously there's some murmurs around that Biden's mental acuity deterioration is accelerating, and that there are increased amount of insiders and Democrats who kind of think, well, this is a problem. And if he just doesn't deliver at this debate, and he is really exposed in some way, or he has some sort of, and excuse the pun, but a senior moment, it could be one of those things where it opens up that political risk that he is replaced at the convention. And when is the convention again? So the Democrat convention is in the middle, towards the end of August. Okay. So and if he does poorly, there's going to also be a flow of folks who are going to kind of push into the RFK camp, right? So that brings. It kind of brings in this RFK dynamic, a third party dynamic. And then I think it's the first week of July, Trump sentencing is being announced for his felonies, his potential that he could be put in jail.
When is that?
July 6th, I think is supposed to be when he's supposed to go for sentencing. I also saw, not to do too much more conspiratorial talk, but apparently they just put the barriers back up in front of the Supreme Court. They put the fences back up. And so some talk about whether or not the Supreme Court is going to rule on Trump's role in the insurrection and other cases that are before the court about Trump. So maybe there's some risk that, or there's an anticipation that these are not necessarily market moving type things, but when there's no vol being priced into anything in the U.S. and you do have the biggest election in a while coming up in less than 5 months, where it's not necessarily the case that the two people who are leading the parties are going to be there at the end. It behooves us to monitor those things and think about whether or not they move in a direction that could lead to some volatility.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.